Okay, Rudy here. I've had a question from a subscriber about the YMAX ETF, which is basically a huge income distributor. It's made up of the top 20 ASX companies and pays a dividend like the top 20 companies around 5%, but then it also makes an additional 4% through what they call the covered call strategy. So what that means is, let's take CBA for example. If we look at the price chart of CBA, so this is as of last Friday. So CBA, which looks very ugly, which is why I'm bearish on the index. So it was trading $142. So what YMAX does is these are call options expiring on the 17th of April. So what they do is they go and sell these call options to make it premium income, and that's where they get the extra 4% from. So for example, when they bid and offers, YMAX would be offering them. So take this CBA, so it was trading at 142, so some other people out there, if they want to agree that by the 17th of April they can buy a bunch of CBA shares at say $148, well, instead of buying the Commonwealth Bank shares at $148, is they buy off YMAX for $2. The ability to tell YMAX in April, so in a month's time, I want my CBA shares, the 100,000 that I bought off you or whatever, or the one share. So they're paying $2 for the right to buy one Commonwealth Bank share on the 14th of April for $148. So obviously if the share price is a lot higher than that, then they've made money. But if the share price is lower than that, then YMAX has put this in their pocket and they keep the Commonwealth Bank shares. So that's why YMAX is a good income, because it basically makes half of it from selling those call options, as opposed to but obviously when they do that, if we look at ILC, which is the top 20 ETFs, top 20 companies, this is their share price. So you can see, because they're not selling call options, but their dividends averaging 5%. So you can see there's a bit of growth there, and again why I'm bearish on the market compared to YMAX's share price, which is coming down, and that's because of the fact that people that buy those call options exercise them and effectively take those Commonwealth Bank shares. So YMAX misses out on any upside, but it pays that double the income of a normal top 20 ASX ETF. So it doesn't have that upward growth, but you get that extra income. So that's YMAX for you. So it's probably getting to a stage, if the overall market's going to come down, which I think it will, then YMAX is coming to a point, and it's probably telling us here that extra income might be a risk of additional capital loss. So given the fact that you can probably get 4 or 5% in the bank with some deal, I'd probably cash out and just put it in the bank. Then you don't have to worry about the market falling over, because I don't think the market's going to get back to these levels for quite a while. So that's my view on YMAX. I hope the viewer understood what I was talking about. Alright, thank you.